Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today I'm going to talk about kind of my strategy. Again, this isn't advice or anything like that. It's just my financial opinion. Talking about my strategy for this upcoming bull market in commodities that we're in. We're in it. And I took a good sized position when the ratios were good. We started breaking out, and we're breaking out of these patterns. These patterns that we're breaking mean something. They're all interconnected. Everything in the stock market is interconnected. You could say it's interconnected through interest rates. And I'm going to take a quick look at all this and show you guys what the overall big picture view is. I'm riding these investments for the big picture. I'm not riding the small intermediate movements. And I know people get scared. They hear 500 different opinions on what the market's going to do in the short term. The short term is the least reliable of any of these picture views. Anything can move price in the short term. You can have fears, you can have news, you can have anything in the short term move it. But that's what you have to basically ride through, are those fears and those short-term movements and volatility that you have to almost become accustomed to. I'm going to show you in one of the charts the pullbacks that you had to ride through if you want to ride through a uranium bull market in Paladin Energy. Just as an example, I grabbed it from Twitter. But let's take a big picture view. I'll just show you what's going on so you guys can get a clear picture. So we've got the commodities. This is the CRB index. And in pullbacks, you get three distinct waves. Wave 1 looks like this. Wave 2 looks usually like that. And then wave 3 is usually a smaller wave, and then you break out of the pattern. This is a falling wedge pattern. The patterns are consolidation periods. What that means is that they're unfavorable periods for an asset. Those unfavorable periods are consolidation periods. There's one here, and there's number 2. The way that I came up with the thesis on the channel is I worked backwards from the data. I looked at data like this and went backwards to create the thesis of the channel. And again, the thesis of the channel is based off of inflation, interest rates, and the rotation of money, and using ratios to identify where value is. Up here, the ratio is expensive to stocks. You should have been buying stocks. Down here, you should have been buying commodities. And given the technical chart pattern as well, I would have been a buyer through this whole section in here and in here. Those two circles are buy points. That is a sell point. And you had to have ridden through a pullback in 2020. And I had to do that with some of my money. I had to ride through it, and I bought a whole bunch more down at this bottom here because I know ratios. And ratios tells us value. But here's commodities. 08 was the top. The bottom's 2020. We also had a bottom. And if you looked at ratios, 98.99 was the bottom of this market. But if you notice, you still had to ride through a pullback in 0102. This here, you had to ride through it. Now, would you have lost out if you purchased at the top of here? Not really. You just want to continue to cost average in and ride it all the way up, and you would have made a lot of money, in this vicinity to sell somewhere in that range, or you're selling on the way down, than you would in here. And you're going to have to kind of tie this all together. We're just looking at one chart, and I'll try tying it together as best I can. But right now, we have had a very large movement higher. We could have a pullback where this is the first leg of a three-wave move. This could be the first wave. And I can't tell you exactly when that pullback can happen, but it can happen. And this one here, if you were to look at it, is wave 1, the pullback, wave 3, the pullback, and wave 5. And then you go into a consolidation period. I think that's coming. And here on a short term, you can see that we could potentially have a pullback here. And again, trying to time the short-term stuff's the least reliable. The most reliable is to see this large pattern come into a corner and try to buy it there. Buying things when they're mid-stride can be difficult sometimes. It can be difficult. Looking at, I'll come down to the CRB to S&P 500. 1 second, guys. So the CRB to S&P, you know what? Let me grab something a little bit bigger picture. We'll call it stocks to commodities ratio. And we'll get a big long-term perspective here. This is the big long-term perspective on the S&P 500. So this is the S&P 500 to S&P commodity index. When this is high, commodities are expensive. When it's low, commodities are cheap. And this is throwing a buy signal in 1970, in 2000, just before 2000, and then right now, basically where we're at. It threw sell signals in mid 70s, in 1990, and in 2008. This would be a perfect cycle to hold on to here. So this is kind of the big picture view. If you were to overlay this with the housing starts, there's also another correlation there in terms of liquidity into the system. There's also an energy crisis in 1970. There's these energy kind of crises that also linked up with some of these. So this is what it looks like. We've been going on up, basically on a tear higher. We zoom in a little bit. It still looks good to go higher. I mean, again, I don't try to do the short-term trading. It's the least reliable. I'm in it for the big picture, and we're trying to time our buys the best we can. That's all we can do. And this is a picture of Paladin. This is Paladin Energy. And I've got this shared on my Platinum member website. It's in this presentation that I'm sharing with the question and answer sessions. But look at these pullbacks in the bull market from 05 to 07. The question that you have to ask yourself is, can I weather a pullback like this? A 51% pullback, 19%, 41 or 40%, 22, 48, 28, 17, 41. This isn't a straight run higher. It's a stair-stepping pattern that moves higher with pullbacks. How do you know that this is cheap down here, and how do you know it's expensive up here? Well, that's what we use the ratios for. But the strategy of holding on when the ratio is cheap and holding on until it's expensive and sell it up there is one strategy. The question that I'm going to ask everyone on the channel and everyone who's just viewing this is, do you think you can time every single one of these pullbacks and get it right? What's the likelihood that you mess this up? Probably pretty high. You'll probably sell it at the wrong time. You'll probably think that you're at a top. You might think, oh, the bull market in 05, it's done for. And then all of a sudden you get this gigantic move from $1.50 all the way till $4.50 as you lose out on all of these investments, in terms of returns. I'm trying to ride from the bottom of some of these, even before 05, all the way up till the top. And if we were to look at a ratio there, we can use the uranium to gold ratio, just as a guide. This is what it was at the peak of 07. It's very expensive up here. You ride it, and then you'd sell it on this way down, most likely. That's the way that I'm looking at it. And look where we are today. This is dirt cheap. And a lot of these ratios, they break these long-term basing patterns, and they just don't fail. They could go sideways for a little while. Yeah, that's possible. But when you start to break things to the upside, that is when you get into these bull markets. We were in a huge bear market as we came on down this way. Bear. And the market conditions weren't ripe for this. Now, what is driving this ratio? Supply and demand is. The supply and demand is getting worse as you come down this way. The supply demand goes into deficit as this ratio goes up. Basically, what this is a uranium price indexed to inflation. That's really what this ratio means. You're in an energy crisis. You have deficits running in uranium. I think this will eventually work its way higher. And I'm just using this one as an example. There's other ones that we can look at where they're starting to play with their trend lines to break to the upside. This is uranium to silver. uranium to the S&P 500 looks like it's ready to really start moving here to the upside. And what moves and causes the movements of all of these ratios is they're usually tied to interest rates. So one thing that you want to look at is you want to look at interest rates. And when you look at interest rates, this is the 10-year yield. What you want to look at is, are we in a rising interest rate environment? Are we in a declining interest rate environment? And is it shifting to a new interest rate environment? Are we breaking a downtrend? So here, this was highly inflationary, and it was also highly advantageous for precious metals and commodities. This entire vicinity here, in an increasing interest rate environment in the 60s and 70s. This environment where we came from here to here was great for stocks. Absolutely beneficial for stocks, because when stocks discount a lower interest rate, they discount lower interest rates with higher PE multiples. And those multiples tell us, here's the actually, I'll come over here. The CRB index to the S&P 500 is more or less a way of just charting yields. So in 1981, all the way down, we had a little blip from 02 to 07. This was a blip in a declining interest rate environment. That 02 to 08 is this move back here where it came on up. Then we went into this decline because we had declining interest rates. The environment was not right for commodities. This here is a paradigm shift where commodities could vastly outperform stocks. And usually what you want to do is you want to get in early and then hold on and ride that bull market. You got to ride the bull. The bull's going to try to buck you off. But that's tied to interest rates. And the interest rates, if you notice, are starting to break the long-term downtrend. There it is. Oops. And we're starting to break this to the upside. Boom, 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 we broke. Now we got a little bit of wick at the top. We may do a little back test here on this resistance support line, this line going across. But the big picture view is interest rates are changing. We could be entering a long-term inflationary cycle, which means that commodities are going to do absolutely incredible things on a big picture view. So the strategy here, for me at least, is to identify the big picture view, big picture view down, and then a move that I think will result upward. If that results upward, I think commodities are going to be a fantastic spot to be. Same with precious metals. And this interest rate is also tied to the S&P 500. And you look at those interest rates. Remember the 1960s. I'm going to put it on log to get this so we can actually see it. The 1968, let's go to 68. 68 is right in the early 60s when we had an increasing interest rate environment. Here's the increasing interest rate environment. It's right there. And what happened? What happened during that time frame? In 1968, it peaked out, came down, and we went sideways and broke out in 1982 is when we broke to the upside. 82. Now let's compare that to the interest rate that I was talking about. 1982. Let's find out what happened in 1982. Well, 1982 is in this area where we started to decline in interest rates. Funny how that all matches up. Funny how that all matches up. Declining interest rates and an increasing stock market. And then we start to go up in our interest rates here into 2020, July of 2020. So if we look at the S&P 500, let's see where July of 2020, and they're not going to be perfect, but here's July of 2020, right here, July of 2020. We had one last blow off top, and then the interest rates hit to a point where they started to impact the S&P 500, which was December of 2021, and we started to decline. So this here, with the increasing interest rate environment, we're starting to decline in our S&P 500. We're going into what I think is a cycle that goes sideways like the 2000 to 2012. This cycle in here. It's a consolidation period. This is the beginning of a consolidation period, perhaps. And again, I can't talk in absolutes because no one knows for sure, but it sure looks like we're entering a consolidation period based off of interest rates and how the CRB to S&P 500 ratio is performing. And the market conditions support that. So the question that you have to ask yourself is, can you time all these little market movements? I don't think I can. And I tried it before, wasn't successful at doing it. Doesn't mean that I have to go study more technical analysis. I've done enough of that. It's not nearly as reliable as the long-term big picture view. So when you hear all these guys talking about market movements and people get scared, of all the short-term, intermediate-term movements that people are making predictions, just step back out, look at the big picture. This is going to take time to make a ton of money here. These things usually happen 5 to 10 years, and they can go up a lot. I want the big move. I want the big money, and I want the high probability outcome. In order to get that, you're going to have to hedge yourself with time, and you're going to have to live through volatility and pullbacks that can be 40, 50% in size. That is part of the game. That is the nature of this beast if you want to be an investor. So I just wanted to kind of touch on that. My strategy is to buy low, ride it higher, and continue to add money into it on pullbacks. Try your best. That's all that I can do, is to try my best and to time the pullbacks as best as possible. It's easy to buy things when you're coming and breaking out of chart patterns. It makes it a little bit easier. Do you wait for a chart pattern? Hard to say. Hard to say that you should wait. If you get a big pullback on a stock, that's when I would start to be interested in it, is after it's pulled back 30%. That's when I get interested in it. But stocks, they look like they're rolling over to me. This could tug our commodities lower. You've heard me say that before. This could be the bear trap. People always ask about the bear trap. Well, this is what we're going to be living here. We're going to be living that bear trap. And then the bear trap, when it's done, game on. Game on. When is that going to happen? I don't know the exact timing. But it could happen very soon. It could happen at any time. Maybe it happens now. Maybe it happens 6 months from now. So if you guys like this type of analysis, give me a thumbs up, subscribe to the channel, subscribe to the website, the Platinum membership in the description link below if you want to. I'll post some of this on the website of how these things are correlated. It's real hard to do that because you're going to have to get really big picture views. It's easier to kind of scroll in and out on a lot of this stuff real time. But yeah, I can put it up there, and we'll catch you next time. This is Finding Value.